Welcome back to the Deep Dive. Today is Saturday, February 28th, 2026, and if you've been tracking the market lately, you know exactly why we are here today.
Oh, absolutely. It's been wild.
Yeah, we are following up on a story that has really evolved. I mean, it went from this quiet turnaround into, honestly, one of the most talked about corporate maneuvers of the year.
Without a doubt.
Back in our Q1 2026 analysis, we looked at IOI Properties Group, IOIPG, and dissected that rather startling 900% profit explosion. And we left you with some pretty serious questions about how they were going to manage their debt and what their long-term identity was going to be.
We certainly did. And, the landscape has shifted significantly since that last conversation. Today, we're opening up their brand new Q2 FY 2026 financial report, which is quite literally hot off the press.
Hot off the press and full of surprises.
Right. Our goal today is to see if IOIPG is genuinely sustaining that momentum, or if they are just, riding a wave of favorable accounting. We'll be looking closely at their core cash flows, breaking down a recent strategic pivot into technology infrastructure, and detailing the mechanics of this highly anticipated dual REIT listing.
Which is designed to completely restructure their balance sheet. But before we even get into the balance sheet, we have to talk about the stock price. Because you, the listener, you really need the context of the trajectory this stock has been on.
It's definitely not typical.
No, it's rare to see a mature, heavy asset property developer move like a tech startup, but here we are. On January 2, 2026, IOIPG was trading at RM 2.65. Yesterday, on February 27, it closed at RM 3.45.
That is massive.
We are talking about an incredible 30% jump in less than 2 months. The market is now pricing this property giant at a RM $19 billion market cap. Okay, let's unpack this. What exactly is driving this valuation? Is the stock currently undervalued, overvalued, and what are the arguments for holding, buying, or selling?
To answer that accurately, we have to look past the surface-level market enthusiasm. A 30% run-up in 2 months means the market is pricing in a lot of perfection. We are going to objectively cut through their headline accounting magic, look at the core cash flow, update you on the REIT listing, and see if the massive debt load is finally being tamed.
Right. Let's jump straight into the headline numbers from this Q2 report because, once again, the initial figures look spectacular. I mean, net profit jumped over sevenfold year on year to RM 708.84 million for the quarter.
Sevenfold.
Yeah. And revenue.
Yeah.
It just broke the billion ringgit mark, surging 42.8% to RM 1.804 billion. Now, a sevenfold profit increase sounds fantastic, but we learned a very important lesson in our Q1 deep dive.
You did. The difference between accounting entries and actual cash hitting the bank account. That is the critical distinction here. In our Q1 analysis, we pointed out that a significant portion of their profit came from a non-cash remeasurement gain. It was essentially a paper profit. Now, looking at this Q2 report, we are seeing a similar dynamic, though from a slightly different source. This recent profit spike is heavily driven by a massive RM 567.1 million fair value gain.
Okay, a fair value gain. Let's make sure we translate that clearly for everyone. This isn't RM 567 million in hard cash that management can use to pay dividends or build a new tower, correct?
Correct. It is a revaluation of the physical assets they already hold on their books. Under current accounting standards, if the value of an investment property goes up, the company can recognize that increase in value as a profit on their income statement.
Even if they haven't sold the building.
Exactly, even if they haven't sold it. In this specific Q2 report, a major portion of that gain stems from IOI City Mall. Phase 2 of that specific mall is undergoing its first major rental reversion cycle.
Let's pause on the rental reversion cycle for a second, just to be crystal clear. That means the initial leases they signed with tenants a few years ago are expiring, and they are now signing new leases or renewing old ones at significantly higher rental rates.
Yes.
Because the mall is generating more monthly rent, the mathematical valuation of the building itself increases.
Precisely. And the auditors sign off on that increased valuation, which generates that RM 567 million fair value gain. The other contributing factor is the income consolidation from their full control of the Scottsdale properties in Singapore, specifically the South Beach properties, which transition into a full subsidiary.
So on one hand, it is an accounting mechanism, but on the other hand, it's rooted in real operational success. They're actually charging higher rents, so the asset is genuinely worth more.
It is a reflection of reality, yes.
But I have to ask, if we completely strip away that RM 567 million fair value gain, does the underlying business actually support this 30% stock run-up? Are they generating real cash or just moving numbers on a spreadsheet?
What's fascinating here is that when you strip away those fair value gains, the underlying strength is undeniably there. The core profit before tax still soared by 85% to RM 279.7 million.
An 85% increase in underlying profit.
It proves that the core operations are actually catching up to the accounting valuations. They aren't just relying on paper gains. The actual business engine is firing.
That is a fundamental shift in their bottom line. To understand where that real cash is coming from, let's break down the segments. Starting with property development, revenue here is up 20% to RM 451.6 million. Operating profit rose 78%.
Which is solid.
Very solid. But the big news here isn't just selling residential houses. The massive development occurred a few weeks ago, on January 29, 2026. They sold 136 acres of land in IOI Industrial Park at Banting.
Yes, to bridge data centers.
For a staggering RM 740.7 million. It's almost 750 million ringgit for a single land sale. Why is a traditional property developer suddenly making waves in the data center space?
This is a textbook example of capital allocation. This isn't just a land sale. It's a strategic entry into the booming data center market. By securing a major player like Bridge Data Centers, they are putting that industrial park on the map, validating it for future tech tenants.
It's a huge stamp of approval.
Right. But more importantly, they are turning completed inventories, land that was just sitting there, into immediate massive cash flow. That RM 740 million is real liquidity.
Brilliant way to ride the AI wave without having to actually build the servers. They just sell the very expensive dirt. Okay, let's look at property investment. Revenue up 46% to RM 340.7 million.
And the execution here is what you really want to pay attention to. Specifically in Singapore, IOI Central Boulevard Towers IOI CBT is now 96% committed.
Wow.
And South Beach Tower is 100% committed.
I want to push on this for a second. We hear constant doom and gloom about commercial real estate. Why are their Singapore office spaces effectively maxed out at 96 and 100% commitment when other global cities are struggling with empty buildings?
It comes down to a massive global flight to quality. Corporations are leaving older buildings and upgrading to premium, sustainable, grade A spaces in secure jurisdictions. Singapore is incredibly land scarce, and its central business district is prime real estate. By locking in these long-term leases, IOIPG has secured a high-margin, recurring revenue stream.
Flight to quality makes total sense.
Oh,
And finally, the hospitality and leisure segment. Revenue up 109% to RM 242.4 million, with operating profit growing more than fourfold. What's the story there?
It's deeply connected to the macro environment. Malaysia has officially surpassed Thailand for the second year in a row as the top tourist destination in Southeast Asia.
That is a huge shift in the regional hierarchy.
It is. And with the Visit Malaysia 2026 campaign actively underway, this segment has massive tailwinds. Their hotels are directly in the path of that tourism demand, maintaining high occupancy and high room rates.
Okay, so the business is firing on all cylinders. But here's where it gets really interesting. We have to talk about the elephant in the room from our Q1 deep dive.
The debt.
The 0.95x net gearing ratio. For anyone new, what does a 0.95x net gearing actually mean?
It means that for every 1 ringgit of equity the company has, they have about 95 cents of debt. They're heavily leveraged in a high interest rate environment that eats directly into their cash flow through interest payments.
So how is management solving this? Because they can't just keep carrying that forever.
They aren't planning to. The solution is the Dual REIT master plan.
Right, the real estate investment trust strategy. Let's break down the latest updates on this.
The plan has 2 parts. The first is the Malaysia REIT, targeted for mid-2026. This would be anchored by IOI City Mall. The estimated portfolio value is around RM 7 billion to RM 8 billion.
So they spin off the mall into its own publicly traded company.
Exactly. Then there's the Singapore REIT, targeted for 2027. This one is anchored by IOI CBT and South Beach. Analysts estimate the value of this portfolio at $7 billion to $8 billion.
Which translates to what, roughly RM 21.54 billion?
Right around there, yes.
That is a staggering amount of value. So they create these REITs, they sell their best buildings to them, and they take the cash from the public markets to pay off their bank loans. What is the ultimate goal here? The debt eraser, so to speak.
Hong Leong Investment Bank HLIB projects that the proceeds from these REIT listings could slash IOIPG's net gearing from that precarious 0.9x level all the way down to a highly conservative 0.3x.
Down to 0.3x. That completely changes the risk profile of the entire company.
It does. And if you want to know if this plan is actually going to happen, You just have to follow the smart money.
Yes, the insider moves.
So,
This is the part I love. Filings showed that the CEO, Datuk-Lee Yaoseng, has gone on a massive buying spree. Between January 30 and February 19, he purchased over 28 million shares on the open market. He spent over RM 100 million of his own cash.
that price is between RM 3.219 and RM 3.645.
Exactly. Now, to keep things impartial, we should point out that the EPF, the Employees Provident Fund, has actually been trimming its stake during this exact same period. A cautious listener might say, wait, if the CEO is buying, why is a massive institution selling?
It's a fair question, but you have to look at the mechanics. EPF's moves are typical portfolio rebalancing. When a stock runs up 30% so quickly, it often breaches the strict weighting limits that large funds operate under. They have to trim just to maintain balance.
So it's not a fundamental rejection of the company.
No, not at all. Contrast that with the CEO. His RM 100 million outlay is discretionary. That is a massive signal of insider confidence in the upcoming REIT valuations. He believes the stock is going higher.
So what does this all mean? We have the soaring profits, the data center cash, the REIT master plan, the insider buying. Should you, the listener, hold, buy, or sell?
Well, let's look at the analyst perspectives. The stock is at RM 3.45. HLib is maintaining a target price of RM 4.05.
So they still see upside.
They do, citing that the stock is still trading at a massive discount. It's at about 0.44x its book value, and they calculate the revised net asset value, the RNAV, at RM 6.24.
RM 6.24. That means if they liquidated everything at today's market value, the shares are worth way more than what they are trading at. Let's balance the views here. What is the bull case for holding or buying?
The bull case is strong. The RM 740 million data center deal proves they can unlock trapped value. The massive CEO share buy-in shows confidence. You also have easing Singapore interest rates, which lower their SGD-denominated debt costs, and of course the upcoming REITs. All of this points to massive value unlocking.
Very compelling. But what is the cautious case? Why might someone sell or wait?
The cautious investor looks at that 30% run-up in 2 months and says, a lot of the good news is already priced in. They might want to wait for the actual cash from the REIT listings to materialize before believing the debt is fully managed. Execution risk is real.
Which brings us perfectly to our financial Moat scorecard update. In our Q1 deep dive, we gave IOIPG a Moat score of 8 out of 10. With all these new developments, what is the updated score?
We are keeping it firmly at an 8 out of 10.
Just an 8. I feel like people might expect an upgrade after all this.
The justification goes back to our previous analogy, the castle on granite. The prime assets, IOI CBT, South Beach, IOI City Mall, they're granite. And the castle is stronger than ever. IOI CBT is 96% leased. The data center land sale brought in massive cash. The malls are reverting at higher rents.
The underlying business is a fortress.
But the treasury is still exposed. Until the dual REITs actually list, and the debt mathematically drops from 0.95x to 0.3x, that temporary vulnerability keeps them from a 9 or a 10. They have a great plan, but they have to execute it.
Which brings up something else. This raises an important question for the long term. If IOIPG successfully spins off its best cash-generating crown jewels like IOI City Mall and IOI CBT into these REITs, they will transform from a traditional property developer into an asset-light real estate investment manager.
Right. They'll just be managing the assets and collecting fees, rather than owning them outright. Exactly. So the provocative thought for you to mull over is this. Will they be able to find new engines of growth once their best assets are no longer fully on their balance sheet? Or is this the absolute peak of their asset building era?
That is a fascinating question. Once you sell the golden goose, can you breed another one? We will definitely be watching that play out.
It's going to be a defining transition for them.
Well, we've covered a lot of ground today. Thank you so much for joining us on this deep dive. We really appreciate you spending your time with us to navigate these complexities.
Absolutely, it's been a pleasure.
As always, a gentle reminder, please like this video and comment below with your thoughts on the dual REIT strategy. Are you buying into the CEO's confidence, or are you taking profits after this run-up? Let us know. And don't forget to subscribe to the channel to never miss an update as we continue tracking this stock's evolution. See you next time.